It's easy to feel like you're drowning in information these days, isn't it?
So definitely.
One minute it's global events, the next it's trade tensions. Remember all that noise around the tariff war?
Yeah, feels like a while ago now, but yes, constant noise.
It can be a real challenge to filter out what actually matters, especially for, your financial picture.
Absolutely.
Well, today we're trying to cut through some of that clutter. We're doing a deep dive into some, I think, pretty significant financial news that maybe got a bit overshadowed.
Okay, what have we got?
Recent dividend increases from two huge names in tech, Apple and IBM.
Ah, okay.
Yeah.
The Titans. Yeah, these are cornerstone stocks, really.
Yeah.
Either in people's portfolios or, definitely on their watch lists.
Exactly. And while the day-to-day market swings grab headlines, these kinds of things, dividend hikes, and for Apple, a really big share buyback, they give you real insight into the health and direction of these companies.
That's right. Underlying strength, future plans, it's all in there.
Yeah. So one of them, as you mentioned, authorized this massive share repurchase program, buying back their own stock. The other just hit a really impressive milestone.
The 30-year mark for IBM.
That's the one. 30 consecutive years of dividend increases. Quite something.
Incredible consistency.
So our mission today is pretty straightforward. Let's unpack these announcements, pull out the key details, and figure out what they signal to you if you want to stay informed without getting totally bogged down.
Sounds good. Where should we start? Apple.
Let's start with Apple. Their news came right alongside their fiscal second quarter earnings report.
Yes, and the earnings context is, it's crucial here. Apple's report really shows the challenges, or maybe the realities, of managing a company that's just so massive.
Right. So what was the dividend news specifically?
Okay, so they announced a $0 or 1 cent per share increase in the quarterly dividend. That brings the payout to 0.26 cents per share.
A penny. Doesn't sound like much on its own.
Well, no, but it's actually a 4% increase from the previous level. So percentage-wise, it's definitely noticeable.
Okay, 4%, and when does that pay out?
That's scheduled for May 15th for shareholders who are on the books as of May 12th.
Got it. And then there was the other big number, the buyback.
Yes, the share repurchase authorization. $100 billion.
Wow. $100 billion. Just let that sink in. Now, I seem to remember it was even bigger last time.
It was slightly bigger, yeah.
Yeah.
I think $110 billion was authorized the previous quarter. But still, $100 billion is, well, it's enormous.
It really is. So let's unpack that a bit. What does a buyback that size really tell us? Does it? Could it also suggest they don't have enough places to reinvest that cash right now?
That's a really insightful question.
Yeah.
And yeah, it can mean a few things. A huge buyback like this often signals that the company thinks its own stock is undervalued.
Okay. A good investment for themselves.
Exactly. Plus, by reducing the number of shares out there, it can boost earnings per share, potentially supporting the stock price. But your point about reinvestment is valid too. It might suggest they feel they have more cash than they can effectively put to work growing the business at this exact moment. So maybe it's a bit of both, betting on themselves, returning capital.
Right. Makes sense. Okay, so digging into those earnings, the picture was a little nuanced, wasn't it? Product revenue, iPhone, iWatch, Mac. How did that do?
Yeah, nuanced is a good word. Product revenue was $68.7 billion. That was up less than 3% compared to the year before.
Less than 3%, which I guess highlights that challenge you mentioned at Apple scale.
Exactly. High percentage growth gets harder and harder when your base is already so huge and you've got significant market share.
But the other side of the coin was services, right?
That's where the brighter spot was. Services revenue, think Apple Music, iCloud, App Store commissions, all that hit $26.6 billion. And that was up 11% year over year. Much stronger growth.
And this feels like a really solidifying trend for Apple, doesn't it? Services driving more and more of the growth. It's not just about diversifying. It feels like they're building this even stickier ecosystem.
Absolutely. It raises interesting questions about where they compete next, maybe more directly with other subscription giants.
Yeah, and despite the slower product growth, overall revenue actually beat expectations.
It did. Total revenue came in at $95.4 billion. Analysts were looking for something closer to $94.2 billion. So a slight beat.
And net income.
Also strong. GAAP net income was $24.8 billion. That's nearly 5% better than the previous year and also ahead of what analysts were predicting.
So even with a size challenge financially, they're still performing well.
Definitely. And that services growth is key. It shows customer loyalty and their ability to make money beyond just selling the hardware. That's got a lot of future potential, you'd think.
Okay, so if you're out there looking at Apple, maybe thinking about it as an investment, What's the takeaway on this dividend news and context?
Well, the current dividend yield, based on where the stock price has been recently, is around 0.5%, 0.5%.
Which isn't very high if you're purely focused on income.
Right, so the 4% increase is positive. It shows health, profit returning value, but the yield itself might not be the main draw for income investors.
But you have to see it alongside the buyback.
Exactly. You take the dividend hike and the $100 billion buyback together, and it clearly shows a commitment to delivering shareholder value just through, different channels.
Okay, good perspective. Let's switch gears now to the other tech giant, IBM foundational U.S. tech company. Deep history.
Big Blue.
They also announced a dividend increase, and this one came with that milestone we mentioned.
Yes, the 30th consecutive year. It's really quite an achievement in consistency. They're on track to hit that 30-year mark in 2025 with this latest increase.
That kind of long-term track record, it says something about stability, doesn't it?
It really does. Enduring value returned to shareholders.
So what were the specifics of IBM's increase? Was it also a penny?
It was also a 0.01 cent per share increase for the quarter, yes. But this brings their payout to $1.68 per share.
Okay, $1.68. Higher absolute amount than Apple's dividend.
Much higher. But because IBM's share price and existing dividend are different, that penny increase translates to a percentage hike of well under 0.1%.
Oh, tiny percentage-wise.
Very small.
Right.
Which is pretty typical for IBM, actually. They tend towards these very gradual incremental increases.
Interesting. And like Apple, IBM also beat analyst estimates in their last report.
They did, yeah. For their first quarter, they reported non-GAAP revenue of $14.5 billion and non-GAAP earnings of almost $1.6 billion, both slightly ahead of projections.
So on the surface, both giants seem to be, holding their own financially.
True, but if you look a bit closer at IBM's report, there were some areas that maybe raised an eyebrow.
Oh, like what?
Well, their consulting business, which is a pretty big chunk of their operations normally,
Right.
That saw revenue decline by 2% year over year, down to $5.1 billion. And their infrastructure segment also saw a dip, down 6% to $2.9 billion.
Declines in consulting and infrastructure. That raises a question. What's behind that? Is there something specific going on? I think the source mentioned something about government spending.
Yes, that's right. The article we looked at suggested a possible factor for the consulting slump was cost-cutting measures from the Trump administration impacting federal government clients.
Oh, okay.
And the federal government is a significant client base for IBM's consulting arm. So it shows a potential vulnerability there, right? Reliance on big government contracts could be swayed by political winds.
Which makes that consulting business maybe seem a bit riskier than, say, their software division.
Potentially, yes. It underscores why their diversification, especially into software, is so important. And it's definitely a risk factor for investors to keep an eye on that reliance on large, sometimes politically sensitive contracts.
So is the expectation that these declines in consulting will continue? Or is it uncertain?
It seems like there's still some uncertainty. The article noted the full effect of those federal efficiency drives might still be playing out. So the future performance there is a bit of a watch this space situation, which, again, makes the growth in their software business even more vital.
And how is the software side doing?
Thankfully, that's performing well. Software revenue was up a healthy 7%, hitting $6.3 billion. And crucially, that's a higher margin part of their business.
Right, more profitable. So some headwinds, but a key strength in software. Okay, when can IBM investors expect this new dividend?
The new quarterly dividend, the $1.68 per share, that's set to be paid on June 10th. The record date for that was May 9th.
Okay. And the yield, you mentioned Apple's was about 0.5%. How does IBM compare? Sounds like it would be higher.
It is significantly higher. Based on the current share price, IBM's dividend yield is around 2.7%.
Okay, 2.7%. That's definitely more appealing if income is a primary goal for you.
It is. It really reflects IBM's long-standing strategy of prioritizing consistent, relatively high dividend payouts as a way to return value.
Right. Okay, let's try and tie all this together then. We've looked at Apple, we've looked at IBM, both raising dividends. What are the key takeaways for you, the listener, trying to make sense of it all?
Well, the headline is simple. Both major tech companies hike their dividends. But the story behind each hike is quite different.
Yeah, the scale and context matter hugely.
Exactly. Apple's more substantial 4% raise, combined with that absolutely massive $100 billion buyback. It suggests a dual approach. Reward shareholders directly, yes, but also maybe prop up the stock price a bit, especially since core product growth is, more modest now.
Right. Whereas IBM's increase was tiny percentage-wise.
Tiny percentage increase, but it marks that incredible 30-year streak. It underscores their steady, long-haul commitment to dividends, even if the growth rate is very gradual these days.
It really throws the contrasting situations into sharp relief, doesn't it?
It does.
Apple grappling with the law of large numbers, leaning more on services and buybacks. IBM navigating dips in consulting, but really banking on that higher margin software growth.
Precisely. And despite these different challenges and dynamics, the source material we reviewed suggests both are still seen as, potentially solid holdings for an investor's portfolio.
And didn't the analysts in the article give IBM a specific rating?
They did, yeah. A buy rating was mentioned for IBM.
So it's a good reminder, isn't it? Just seeing dividend increase in a headline. Well, it doesn't tell you nearly enough.
Not at all. You really need to dig into the why, the earnings context, the size of the increase relative to the company, the other ways they're returning value, the overall health.
And the strategic direction.
Absolutely. Understanding those nuances is key for making informed decisions. A small increase might mean stability. A big one might mean something else entirely, depending on the company.
Okay. So as we wrap up this deep dive, it feels clear these moves by Apple and IBM, they offer real insights into their financial health and strategies.
They certainly do. You've got Apple's big buyback and dividend hike, underpinned by strong services growth signaling confidence, perhaps tempered by their scale. And then IBM hitting that 30-year dividend milestone, emphasizing consistency and the promise of software, even with some consulting headwinds.
It really makes you think, doesn't it? What are these moves signaling about their confidence in the future and about how they choose to reward their investors?
Yeah, and that leads to the final thought for you, the listener. How does this specific information, Apple's approach, IBM's approach, fit into your own view of the wider tech sector?
And maybe even more importantly, how does it align with your personal financial goals and your investment strategy?
Exactly. Definitely something worth mulling over as you navigate things.